Hey, so we're back looking at XLF. So this is the financial sector that we're looking at. The last time we looked at them was on April 7th, so close to, I don't know, 3 weeks ago at this point. Uh, when we last checked, it was trading at $31. We're now at 33. We currently have the 1 month chart right here in the middle, this green graph. And you can see the uptrend. There was a slight dip, nothing crazy, but overall it's gone up about $2. We had a buy point marked at 30 and a resistance point at 40. So just on the outside, it doesn't seem like much is going to change, but we will go over some news aspects for this and then wrap up with the technical analysis. And if you have any questions along the way, by all means, let me know in the comments. Or if you feel like I missed something in the news articles, feel free to share that. I'd be happy to read it. But with that said, let's go into the news. So, right off the bat, this kind of gives us a idea of what all the different sectors are meant to do, especially from this point going forward to the end of the year. And it brings up a couple points for the financial sector for banking. So it says, despite the turmoil in the regional bank industry we saw in March, the financials sector is expected to see strong earnings growth. Analysts are forecasting 2.4% growth in quarter one and 10.5% growth for the full year. So, very positive. It also mentions how the big banks are meant to kick off their earnings, such as JP Morgan, Citigroup, Wells Fargo. We will touch on that in another article, but that's just giving us a little heads up of what to come. Uh, it gives us this nice little snapshot of all the different sectors. And so we have the financials right here. I didn't mean to highlight everything, but right here. So it shows more or less what we read earlier, that it's expecting 2.4% in the current quarter, 10.5 going forward. And it's just nice to see the breakdown of all the different sectors, because we are going to be covering most, if not all of those over time. But now let's get into two of the more important articles. We'll kind of go through these, break it down as neatly as I can. So number one, it's just starting off by saying it's set to report, or four giant banks are set to report very soon. So we have JP Morgan, Citigroup, Wells Fargo, PNC, and then next week there was Bank of America, Goldman Sachs, and US Bank Corp, and Morgan Stanley. As we continue along, it says, where is this? Analysts expect JP Morgan, Citigroup, and Wells Fargo to show increases in revenue and profit for the first quarter compared to a year ago. Net income is expected to drop for JP Morgan and Wells Fargo when compared to the prior quarter, however. So we'll see if that actually kind of happened. The biggest concern across the sector is the effect of rising interest rates are having on everything from deposits to assets. So it goes on about that. Many bonds held by banks are underwater, creating a potential for huge losses if banks are forced to sell. So basically, I think how that's working is there's basically two cases. You can buy a bond for a premium or a or a discount. And so it seems like because of what's kind of been going on with the economy, a lot of banks have been buying them at the premium. And so if they sell it short, they'll actually be losing money, and if they can't hold it until the maturity date. And so that's kind of where that's coming from. Uh, let's see, what else do we have? Banks, including JP Morgan and Wells Fargo, had been losing deposits as customers sought out higher rates being offered by money market funds. So this, if people are taking money out, that means the bank has less money to use to gain interest or use how they please. So that's obviously a bad thing for them. Let's see, the trickle, let's go down. The trickle of deposit outflows turned into a flood for some institutions during the second half of the month. They're talking about March. Banks lost a total of $500 billion in deposits through March 29th. Uh, Again, so that has to do with the whole, uh, what they were calling a banking crisis, where those couple banks ended up uh, going bankrupt. And we saw a lot of people pulling money out of obviously those banks, but then other banks just because they were worried that something might happen with their bank very similar to those banks. Um, let's see. Let's keep scrolling. One positive for banks is that higher interest rates do allow banks to charge more for loans, and that may help boost their income. JP Morgan said in January that it expected a boost net interest income by 11%, which would be $74 billion. So clearly, with people pulling their money out of their deposits, meaning less money for the banks to use and gain their own interest on, they're saying it's offsetting due to the fact that anytime someone borrows money, they will gain a higher interest rate on that. And uh, not sure how much it's offset. It's clearly offsetting enough that at least J.P. Morgan's saying that they're going to see a positive 11% interest income for them. Uh, Not sure how it's going to shape out for all of them. I think the next article will touch on it a little bit more. JP Morgan seems to be the focus of both articles, but the second article does kind of branch out and touch on, I think, PNC a little bit, Citigroup. So let's just keep going along. There was this analyst, Betsy Grassick. She basically was saying that she revised down predictions for bank profitability over the next 2 years due to rising deposit costs. So what they're thinking, and we're probably going to touch on this a little bit later, but just to give you a heads up, it's like because people are pulling out money from the banks to put it in these money mutual funds, what banks are considering doing, if they're not already doing it, is they're starting to raise the interest rates on their, I guess, savings accounts just to kind of compete with those money mutual funds. And that way they can start seeing deposits come back in, which of course costs them a little more money, but the trade-off clearly would be worth it. But of course, we'll see how it shapes out because they are saying it will reduce their overall interest income. But of course, we'll see how everything plays out. If we keep going, bank lending did fall by nearly $105 billion across the industry during the 2 weeks ending March 29th. Let's get that out of here. Due mostly to the pullback by smaller institutions, and this was the largest drop since 1973. So I guess we can look at it two ways. I mean, the financial sector, obviously, it's all these banks, but there's clearly more weight on the larger banks, and we can just look at that. I'll try to pull that up as I explain this. This one. So even though a lot of pullback was from that, it shouldn't really impact the majority of this position, and I think we can see that based on the fact that it's still rising in price. And so if we go to the holdings, I mean, you can see we're touching on a lot of the major banks here. The major banks make up half the portfolio. So yes, I would imagine while the other medium to small banks, they make up the other half. But I guess, so it's overall should be balanced is what I'm getting at least in this case. Let's see. So there was a pullback. So President Biden got involved in this. He's asking regulators to strengthen rules governing the oversight of regional banks that were loosened at the end of the last decade. JP Morgan CEO wants to counter this, saying it was unlikely that tighter regulations would have stopped the sudden deposit outflow that ended up sinking Silicon Valley Bank. Also pointing out that depositors pulled $42 billion from that bank in the final full day of business. So it's kind of hard to prevent something like that because, you know, a shock wave such as what happened with them. I mean, the bank only has so much money on hand, But to see such an outflow like that, I mean, that would be detrimental to any bank, and especially the smaller, the harder it's going to get hit. And that's what basically JP Morgan CEO is saying, that no restriction or regulation could have really prevented that. Um, and so he's just saying, let's not go crazy on the restrictions because it might end up hurting the industry down the road, just to kind of fix this one incident that really there wasn't much you could have done about that. But now let's go to the aftermath. So this kind of gives us some more results, and it kind of touches on points we mentioned in the earlier article, but we'll try to just go through that as best we can. So the four of the nation's biggest banks said first quarter net income and revenue surged from a year ago, demonstrating resilience in the industry. J.P. Morgan reported a profit of $12.6 billion. That was up 52% from the first quarter of 2022. Its revenues of $38.3 billion was up 25% from a year ago. And then we have Wells Fargo earning $5 billion, Citigroup earning $4.6, and PNC earning $1.7. So it seems like a lot of people are growing. It doesn't give us the side by side, and I don't follow these individual companies close enough to know how much they've risen. But the way it's formatted, I'm assuming it's a positive thing for the industry. If we keep scrolling down, let's see. It goes on to say deposits at JP Morgan, Wells Fargo, and PNC fell by 7, 8, and 3%, just kind of like how we expected based on the previous article. They also mentioned that JP Morgan and PNC deposits did rise slightly, however, compared with the fourth quarter of 2022. So that kind of offsets a little bit when we're looking at year over year versus quarter over quarter. More or less, it kind of balances out there as well. This kind of is a repeat of before, how the turmoil in March, lenders, big and small, had been losing depositors to money market funds to offer higher yields. We kind of explained that earlier. The outflow of deposits from all of the nation's banks reached nearly $500 billion last month through March 29th. The CFO, Jeremy Barnum, told reporters Friday that the bank took in $50 billion in deposits in last month, but he also mentions that this was most likely due to some customers moving their money from regional banks into there. So in terms of the financial sector, the money is still kind of in the same spot. It's not like it moved from the financial sector to another. It's just JP Morgan got pushed up a little bit, and maybe some regional bank that's not as well known, they lost the other 50 billion, but in all it should have balanced out here. Continuing along, let's see, scroll down. Okay, so the rise in interest rates over the past year also benefited some of the larger banks, JP Morgan and Wells Fargo included, because it allowed them to charge more for their loans. Again, we touched on that before. Let's see. JP Morgan's net interest income was up 48% compared to the year ago quarter, and it raised net interest income expectation for all of 2023 to $81 billion. So very positive. They don't show us the year by year, but it does say 48% compared to a year ago quarter. So assuming that trend continues, then it should be positive for them. It goes on to go into Chief Executive Jamie Dimon said in a call with reporters that the net interest income will come significantly down next year, and I think that's a more important statement than it was for this year. So he's given us a heads up that net interest income, while this year I guess it's projected to rise about 11%, he's saying the next year that's probably going to get pulled back, and I have to imagine that's because these depositors that pulled out money and are putting them into these money mutual funds, that money's probably not going to come back, or if it does, it's going to be in small quantities compared to how it left. So like $50 billion left, maybe say 10 or 20 will come back. That's what I'm kind of estimating here. Uh, and then also, if the interest rates pull back, so right now, I don't know, they're like between 7 and 8%. If all of a sudden next year it's like 6%, that means they're losing that interest income because the lowered interest rates. So they're getting hit by two sides next year. So this year, the results should be good, but he's estimating that next year it's probably going to be not as good. And so we'll keep that in mind as we look at the technicals for this. But let's keep going along here. So investors are looking for any signs that banks are making fewer new loans, which would affect the larger economy by reducing the flow of credit to businesses and consumers. Lending across the industry fell by $105 billion during the 2 weeks. So again, we touched on part of that point, but the added piece here is the investors are looking at that, and they're going to use that to determine how's the economy doing. They also mentioned how most of that pullback was in smaller institutions. So keep that in mind for if you want to pick out, say, a JP Morgan versus a regional bank, both publicly traded, but one's clearly, has a better chance of survival here and probably won't see an impact as greatly as a regional bank. One lending business has clearly slowed at JP Morgan. I would assume this is the case for most banks too, is the mortgages. There's not as much demand for new borrowings now that interest rates are much higher than they were a year ago. Home lending revenue was down 38%. That is, I'm not surprised by that. I guess I'm not sure in terms of percentages if that's surprising, but yeah, I think we all knew that was going to happen. I don't know if that's the right percentage that people were expecting, if it should have been higher or lower, but in the grand scheme of things, that's kind of what we expected. And then the last thing I wanted to touch on is how JP Morgan increased its provisions for credit losses by 56% compared to a year ago, a sign that it expects more debt to go bad as the economy slows. Higher provisions at Wells Fargo included $643 million increase in allowances for credit losses on commercial real estate loans, as well as credit card and auto loans. So these banks are expecting, it's this year, so they're expecting, because of these higher interest rates, that people are going to default on some of these loans or maybe not be able to pay them. Hopefully not forever. Hopefully they don't back out of the whole debt agreement entirely, but they are expecting the worst, and we're seeing that in this provision. So again, we'll keep following this, see how this all plays out. But at this point, let's jump into the technicals for this. And so here we are. Let's zoom in just a little bit. Up at 33, we did have this buy point at 30, and for me, again, I missed out on this one. I just need to pay more attention to my buys specifically, because I would have bought this one at like 31. That's close to 30. It would have been worth it to me. So while this one seems like it has large candles, it's really because it's such a small window that it makes it look larger. But overall, it's not. It's a pretty cheap ETF. So anyways, we're at 33. Last time we looked was right here in this red candle, which was when we caught it in the 31 range, a very high $31 range. So for what that's worth, it's gone up about $1.20 from that low to where we are now. So nothing crazy. In terms of me, for me to buy this one, yeah, optimally, I would like to get it closer to 30. If we scroll out just to see the lines that I drew in here, this at that time, whenever I first kind of opened this account and started looking into it, I set up what I thought would be a good buy point, which was the 30. I put in two fair value ranges. which are between 34 and 37. So the fact that we're still below that fair value range, I still feel like this is a decent time to buy, especially considering this industry is meant to go up this year. Not sure about the following year, so we do have to keep that in consideration. And then ultimately, resistance at 40. We'll see how this plays out at year end. But I guess let's just update the tracker for a quick second. So it's currently 30. Buy will stay at 30. Or currently it's at 33. Buy will stay at 30. Resistance still at 40. We'll update the date. Yeah, I mean, this isn't a bad time to buy. I think how I would treat it is if you don't have any of this ETF in your portfolio, but you want some, and let's just say hypothetically you want to have 10 shares in total to build out this position. I think at 33, I might buy, say, 2 or 3 shares of this. If it continues to rise, maybe just kind of be patient. However, if it pulls back a little bit to the 32s, maybe add on another share. If it pulls back to 31, add on another 2 or 3 shares. And then if it pulls back to 30, you would complete the position. I think 30 is still possible for this one. It's, it's hit there recently, back in October. Don't see why I couldn't do it again. Even in March, it came very close. It was in the $30 range, not as far down as our green buy point, which is technically it's almost $30 on the nose, but here at $30 and like 85 cents, the point is you were still in that $30 range. So overall, like for me, I feel like there's going to be better buys out there. So me personally, I'm probably going to, if I would have actually pursued this one at 31 like I should have, I would have been happy with that. But now that we're at 33, I'm willing to be a little more patient, see if we can catch this one maybe a month or two down the road and it's back at like 31 or 30. Sure, I'll pitch in, maybe buy 2 or 3 shares and start to build a position here. But for me personally, that's kind of how I'm seeing it. If you have, let me know your thoughts. Or do you think it's worth the risk, especially going over what we just did about how this year's meant to be good, but they're already forecasting next year's probably going to get tighter of squeeze in terms of earnings. That kind of makes me nervous about buying it now too. If they were saying it's going to be good again, like if they would have left that piece out, I would probably say, yeah, I'm interested in buying. Just honestly, I'm considering just adding one share just to say I have it. I think it's at a decent price. I wouldn't complain about it. Again, it's below fair value, in my opinion, which is the blue, between the blue lines. I wouldn't be upset with it. It's just, I just feel like I'm willing to wait for it. So I probably won't add anything to this, or even start a position in this. But, that's just my opinion. Let me know what your thoughts are on this. I'd be happy to hear just a different point of view. But with that said, please like, subscribe, and I'll see you in the next one. Bye.